Okay, welcome out to our video here today. Today's topic, I'm going to be talking about earnings season, what to expect, what to think about, how to plan for it, and what you may need to do next in your own education and trading to be able to take advantage of this time of year. Let's talk about earnings for a minute, and we'll be bouncing around the web just a little bit, looking at a few things. Earnings season happens pretty much every 3 months. Now, what that means is that a lot of the major companies in a market are going to come out and report earnings during that time. What it does not mean is that there's not earnings dates at other times of the year. In fact, there are earnings every day in the market, if you go in and you look at it. But when it comes to the markets and what to expect, earnings seasons are traditionally thought of as January, April, July, and October. And the reason is that's the traditional accounting cycle. The quarter ends in March, and so people report in April. The quarter ends in June, so they report in July. It ends in September, they report in October. It ends in December, and they report in January. So after their accounting quarter ends, within 30 days, they usually will report, sometimes a little bit longer. Now, right now, we're in the April earnings season, okay? This is what we're up against right now, what we're looking at. But this information and this content would apply at any earnings season. Let's go talk about it a little bit. Okay, looking at the earnings dates, there are a few things that are very helpful. Here at tackletrading.com, I'm going to go into the clubhouse. Actually, we're going to go into Trade Center first. And we're going to look at a heat map. Heat maps can measure a lot of things, and one of them that they can measure is the earnings date. Now, what you should see in front of you right now is a lot of pink, okay? That just happens to be the color sequencing that the heat map uses to tell you when a company is before earnings. 99% of the market, the S&P 500, 95% maybe is pink. Pink or a little bit darker pink. So you've got Google, Facebook, Microsoft, Bank of America, Apple Computer, General Electric, ExxonMobil, Chevron, Disney, all of them are about to have earnings. There are several bits of information that you absolutely have to go look up if you're going to trade. Number one is the earnings date. A couple of things that you can do. If you're a Thinkorswim user, and if you've set your chart up correctly, you can look up this information. Now, just in case anybody's new to Thinkorswim or doesn't use Thinkorswim, I'll show you a couple of different locations. I'm going to take Apple Computer here. I'm going to dump all the drawings out real quick. And yeah, that's right. That works. Yep, you bet. Okay, there we go. For some reason that didn't come out. So hold on. Remove drawings. All drawings, yep, get rid of it. Okay, there we are. If you click on Style and then Settings, you can go into the time axis. It's an available field up here, and expand your chart to the right. Now I'm going to show you what it looks like without it. If you have zero expansion, what that does is it hugs the chart up to the very far right side of your picture. You don't want that for a couple reasons. Number one, I don't think visually you can see things as well when you do that. I see people missing information when they do that. Number two, you can't peek ahead at what's going to be happening next. So if I go to Style and I go to Settings, now I have several choices. I'm going to use the 50 bar setting right now. Okay. Click Apply and then click OK. There are several things that happen now. I can now look ahead to see when events are going to occur, whether it's a dividend payment or an earnings date or an expiration for April or May. Let me kind of explain some of the information on the graph. The red telephone is the conference call. See, when a company has earnings, the CEO or the CFO or whoever's doing the meeting comes on and they talk to their investors, the analysts, their key investors. Usually this is a public meeting, an open meeting. You can even find some of them on the web. And they'll communicate what they're doing with the market. Okay. They also have an event or a news release where they issue their earnings information. Generally, the way this works is they'll give the news release, and an hour, 30 minutes, an hour and a half, whenever, maybe even the next morning, they'll have the conference call. Okay. You have to look up both bits of information. For Apple Computer here, let's look at this. It says 427A. So when I'm listing out earnings, one thing I will always do is I'll find that little telephone, but also then I'll make sure I know whether it's a 427A or 427B. A is for after the bell, after the markets close that day, and B would be for before the bell. How you trade it would change a little bit. See, if something's coming out on the 27th before the bell, that means I have to do something on the 26th at the very latest to avoid the earnings gap. If something is happening on the 27th after the bell, that means I have up until that day through the day because it's not happening until after the market's closed, so I can trade up on the 27th. A or B is important information. We're looking for either before the bell or after the bell. That's key information. Other things that it does when you, let's go back here. Other things it does when you look at the chart and you have that expanded area on the right, these vertical dotted lines, those are expiration for the options. Now, when you're looking at an equity, it will give you the date, okay, 4/17, that's for the April. It doesn't show the weekly if the stock trades weeklies or if the index trades weeklies. I think the default on the software is just to show the expiration month. Now, if you're looking at a futures contract, it will show those futures when they roll from one to the next. So like this one here, these blue lines are the futures contracts changing, okay? So that's something GCJ5, GCM5, the specific futures contract expiring, because it doesn't necessarily expire on the same day as an option for a stock. Something you have to be aware of if you do trade futures. Now let's go back to Apple for a minute, or maybe even we'll go to a different one like Google. There are several different ways you can trade, and I'm going to be giving some tips and some direction and some advice here a little bit later. One thing that you should always do is double check the date. I want you to see one right here. This says earnings 423 after the market. If you remember on the heat map, Google said 415 after the market. Which one's more accurate? What I've found is that data from places like FinViz that are streamed and that kind of thing, or even Earnings Whisper, if I can type earningswhisper.com if you don't have FinViz or Thinkorswim, or Tackle Trading. If you don't know where to go, you can always come over here. You want to double check that source. I think Thinkorswim is the most accurate. So this 415A, I would be very cautious about planning a trade around that. Now, you don't see that all the time, but it says 423A here. I would want to double check some of this information. Let's find a different one. Let's look at Netflix. Okay, here's one. It says 415A, tax day, just after the bell. We look at Earnings Whisper. We can confirm Netflix 415A, so we know the date is correct. Okay, now let's talk about how to plan for this. There's several things that we need to think about if we're trading earnings. Not just the date, but also the implied volatility. This is a key concept. Implied volatility is a reflection of option pricing. It goes up and down. You can find this information either indexed as an average for the stock that you look at. You can usually get that on the chart. I'll go show you that in a minute. Or you can find the individual implied volatilities on the stocks that you keep track of by looking at them in the option chain themselves. Both bits of information are very important, but the theory is more important as we talk about earnings. Implied volatility tends to go through a cycle. It usually will go up, and then on the earnings, it will crash. It will fade for a little bit, up, down, or sideways. Then it will build again. It will crash. It will fade for a little bit. It will build again. Whether it's sharp or gradual, depends on the conditions in the overall market. Then it will crash. Now, these crashing environments in implied volatility, we call this the Volatility Crush. This is a term you'll hear traders talk about quite often when they're trading earnings. It's on the earnings date when the implied volatility drops like a rock, okay? Now, this is priced in. It's part of options trading. It's part of what happens. The volatility build, vol build, and you'll hear, that phrase vol for short quite a bit. Vol build, happening before earnings. Now, there's several things in here that are very important to understand. Every condition in the market, if it's consistent and predictable, produces a strategy. Okay, think about that. Every condition in the market, whether it's going up or down or a dividend or time passing or something's neutral or something has volatility rising or crushing out or whatever it is, every single condition in the market, if it's predictable and consistent, creates a strategy on a way to play it. Okay, there's a system in there somewhere. We're talking about volatility because volatility has a very direct part of earnings season. It's what is built into the earnings. We're going to go through some examples here in a minute. We're going to walk through them, and we're going to kind of build out some strategies. I'm going to help you understand it. But there's two distinct things we can trade. Now I want to go talk about those. We'll be bringing up some different windows as we go. We can either trade the volatility building. And this is a pre-earnings trade. Or we can trade the volatility getting crushed, or the volatility crush. And this is a during or a through earnings or post-earnings trade. Okay. Now, strategies that fit both of these. Volatility building, we're going to call that, you want Vega positive. So strategies that are Vega positive. Calendar spreads, diagonal spreads, straddles, strangles. The most common one that you see people doing, and this is actually taught in the Options 2 class, is a straddle. And all a straddle is, and we're going to go through it in just a minute, is where you buy options hoping that the volatility builds enough for you to make money on it going up or down. Now, this is thought of as a pre-earnings trade because you tend to get into it 2 to 6 weeks in advance when the volatility is at a low point. Volatility getting crushed. Well, how can you do this? Well, you can use credit spreads, including, and by the way, this is a Vega negative trade, and a bull put, a bear call, an iron condor, short strangle, just for my boy Dean Beckett, the big cat, who does some assistant shows over at Tackle Trading on Wednesdays for you pro members out there. Also, outside of short strangle, you've got like a bear crystal, things like that, or what I would call also specialty ratio spreads. Like I talked a little bit about a handlebar mustache trade last earnings season, which I personally really, really like. But these are Vega negative trades. You need to look at this list right now and ask yourself, what do I want to trade? Okay, let's go back to the other graph here for a minute. Do I want to play the volatility building? Okay. Do I want to play the volatility building, the consistency of having just volatility move up the chart and trying to take advantage of it? Or do I want to play the earnings date itself and play the volatility crushing? It's more risky in terms of just having to be there, understand the event, and be a part of an earnings gap. It's also shorter term in duration. There are trade-offs there. We'll go through a few examples of both. Let's start with this list. Volatility building can be any of these four, but it can really be anything that is Vega positive. And so as you learn options, look for whether or not something has a Vega positive risk profile or not. Vega measures the impact of implied volatility changing. We're going to go through a graph here in just a minute. As you look through this list, you can think of, well, what is Vega negative? Because earnings are also unpredictable, using a bull put or a bear call tends to not be very common by traders. Iron condor, short strangle, short straddle, bare crystals, special ratio spreads, things like that. They tend to be much more common by a trader. Now, this is if you're playing the Volatility Crush. There's also an entire other family of trades which is going to be left outside of this, and actually the handlebar probably better fits on this, which are called gamma scalps, where you hold through earnings. Okay, let me get this. Looking for a big move. Okay, this tends to be what we call a bi-directional trade, and that handlebar mustache probably fits better on this. So like the handlebar mustache, inverted, butterfly, short-term straddles / strangles, inverted, calendar, anything where the risk graph, and I'm going to draw a risk graph for this one to help you see it, is when you're looking at a risk graph and it has open-ended profit on the high side and the low side. That's kind of what you're looking for. Or at least not, even if it's not open-ended, you have profit up, profit down, but a loss in the middle. So if you're building where it's a profit if it goes up, a profit if it goes down, but you have a loss if it sits in the middle, that's a gamma scalp. That's a bi-directional trade, and these strategies would fit in it. And that's a conversation for another time. We're going to focus on either playing the volatility build or the volatility crush. Now, the most common play is a straddle, and for me, a short strangle. So we're going to focus on those two strategies. Let's start with the straddle. Okay. Straddle. Straddle is a simple trade. Okay, what you do is you buy a call, you buy a put. Both strikes are the same. Both expirations are the same. Okay, you need to apply your money management rules, determine how many contracts you're willing to work with, and come up with management plans as well. But let's start with the entry construction. Okay, you buy a call, you buy a put, both strikes are the same, both expirations are the same. The risk graph on a straddle looks like this. You have a flat risk graph. It can go up. It can go down. You make a profit on both sides. Well, let's think about this. Doesn't this look exactly like the gamma scalp risk graph I just drew? Yes, it does. The difference is in the expiration. Expiration on a straddle where you're playing the volatility build needs to be somewhere out in time, somewhere like 2 to 4 months out. And that's because Vega is higher, Theta is lower, and Gamma is lower. You're not getting the same Greeks. Whereas in a gamma scalp trade, your risk graph, your expiration will be shorter in time. Okay, and that is because Vega is lower, Gamma is higher. That's the main reason. You're taking advantage of the math behind the Black-Scholes model and in options in general. We'll go into some examples here in just a minute. Straddles. Straddles, again, are a way to play the volatility build. It's a decent strategy. There's nothing wrong with it. The math behind the trade makes sense. Some people really like it. Some people like the patience of it. The one thing that you have to remember, though, is you're buying options with time decay. So volatility may be building, but you're fighting the clock because time is passing. So what you have to look for is you have to look for a condition where the volatility is going to be building enough to offset any loss from the time decay impact in the trade. Let's go look through an example. So to find stocks with earnings out in time, let's look at the entire month. And let's just look at the S&P 500 for now. Here we are. Okay, 346 candidates that have earnings this month. I wonder if we have a next month. Nope, not in FinViz. All right, we're going to do volume over 1 million a day. Okay, we're going to do price. Let's do something a little bit mid-range, like 50 to 100. Okay, there we are. And I wonder if I can customize. Let's see, custom. Earnings are right here. Let's organize based on earnings towards the end of the month. Let's write a few of these down just for our examples. We'll go make a decision based on the implied volatility. So AIG, AKAM, CERN. We'll write down, well, let me find a few decent ones. FLIR might be a good one. Oh, Skyworks Solution, SWKS. Visa's a big company. Okay, CME Group. What do I got? 7 on my list. We'll go through these over on the other page. And I'll put ConocoPhillips on there for good measure. All right. Those are all towards the end of the month. Being, 17 days out, it does fit our model. Now, some traders would look even further out, like 4 to 6 weeks out, into the May expirations. That'd be okay. I would have no problem with that. I couldn't argue with that. We're just using this for our example right now. Let's look at some of these charts on Thinkorswim. Now, the first part of deciding whether or not one of these stocks is a good candidate is to look at the implied volatility and to make a decision on if it's at the low end of the range. I've added implied volatility on here as an indicator on my graph. If you want to do this in Thinkorswim, you go to the studies, you find it in the studies, just start typing IMP. If you type out the word implied, it won't find it. Or you can just type out the word volatility and it will find it in the list right here. If you don't know how to locate this button I've just clicked on right here, you could always go to Studies, Add Study, go down to Volatility Studies, and it should be right there. Base settings are fine. Okay, so here we are with AIG, and we're looking at it. Now, the volatility is at 23%. The last earnings, it was only at 24% when it had earnings. The earnings before, 23%. Doesn't seem like it's at a low point. It seems like it's about where it normally is before the earnings. Doesn't look interesting to me. Akamai. Well, volatility was, look at this one. This is actually a really consistent pattern. Volatility rose, but then about 2 weeks out, it started to flatten out. It rose a month out, and then it flattened out and then crushed. Okay? It rose, but then it flattened out. It looks like we've missed when it's consistently rising. So Akamai would have been a good straddle, say, a couple of weeks ago when it was at a low point. We've pretty much missed that one, but there is a consistency there. When you start looking at volatility charts, you'll start to see some of that consistency. Okay, volatility built up aggressively right at the end, towards the end of earnings, then it crushed really good. CERN built up aggressively, then it crushed out really good. Looks like at the end of April, we might have missed some of these. Let's look through. We might have to look into the May contracts. FLIR, it's at 27% volatility. The last earnings, it was up at 35. The earnings before that, a few weeks before it hit 35, but then even back in here it was at 27, 28. It seems to be fairly priced right here. Keep looking here. SWKS. Volatility built, crushed out, built, crushed out pretty good from here. It looks like these ones are already overpriced in volatility, even with just a few weeks out. We may have to change our scan here. Still got a little room for Visa to build up, but we would be wanting to look for this at a lower range. See how when it's all the way at the bottom, it starts to build in. It looks like about a month before. Usually you're getting a good build. So the end of April isn't going to work for us, is it? Okay, we haven't found one. I had 8 on our list for April 30th. Not one here is looking like we're at the low end of volatility. So what do? Well, we'll go run a different scan here in a minute. Built up already, then flat 2 weeks before. This may be a good tip for those of you who do trade straddles, is that you can't wait all the way till the end. Even if you're 2 weeks out, if you've built your 10 or 12 or 15% profit, you need to take it. Vega-based trading is not going for triples and quadruples. You're not hitting home runs. You're going for still 10, 20, 30% profit on your underlying cost, and you're moving on. You can't always wait until the earnings, especially if you're playing these IV trades. So let's go back. Let's see if we can find some different ones. Let's see here. Now, if I, oh, very interesting, very interesting. Did you guys see this? Okay, if I click on the entire sector, it will give me a list of everything right there in that box that pops up. Now, I'm looking for stuff out in May, like mid-May. XCC is on that list. Okay, May 19th. Nothing. There's some May 5th. Maybe I can put one of those down. APA is May 7th. Put that down. Basic materials. Majors, no. Let's look for some of these big spaces. Healthcare is mostly the end of April. Diversified. AME is May 6th. Maybe we can get some of these way out there. Utilities. Got some May 7th in there. A few of them in there that far out. Add AEE. AEE would be a good one. Okay, writing a few candidates down. Oh, Trip Advisors, May 6th. TRIP. Money centers, those are all this week. See, the darker the color, the further out. So Walmart, here's a good one. May 19th. Home Depot might be a good one. May 19th. Home Depot. We got plenty here. Okay. All right. So let's go out and let's take a look at the volatility patterns on some of these. Okay. XCC. So we went out a week, 2 weeks, 3 weeks further. Okay. Here we are. Implied volatility at 36%. The last time it had earnings, it was at 51. I'm looking at a number over here on the right. Okay. I was also, here we're at 50. Now, it only hit 37 here, but it did build in good from a low point about the mid-20s. Built up strong and then faded out. I'd say we're at a low point in volatility. I'm going to qualify that one. Okay, circle it on my piece of paper. Interesting candidate. Cimarex Energy. All right, Apache. About to break out of resistance here, by the way. Got good, strong resistance near 70. Volatility at 35. It was up at 42 the last time. The time before that it was only 35. It doesn't seem all that consistently building into it. I'm going to skip that one. AME. Really inconsistent, choppy volatility. I think we'll find something better. We already have one better. AEE. Same thing. Utilities don't have a lot of volatility to them. Trip Advisors, maybe this will be a good one. Ooh, baby, look at this thing build. It builds up and then it crushes back. Builds up pretty high. It actually is on its way. It's from 46, and it looks like it's going to be heading all the way up to 55. Now, this is actually a candidate because trading something positive Vega does not mean you have to find it at the lowest point in implied volatility. It has to mean that you're bullish on implied volatility. It's that you believe it will go higher from here. Looking at Trip, it does look like it will go higher from here. It looks like it's on its way into the mid-50s or 60. If it goes from 46 to 55 or 60, that is bullish implied volatility. This is a mistake some people make. They look at implied volatility and they'll look at it on an implied volatility graph. Okay. And it's great if you see something coming all the way from a low point and you catch it right when it turns. That's cool, isn't it? Now, does that mean it's the only time to play it? Not necessarily. If something consistently always ends up here, and you catch it on the way right here, isn't this also a good time to buy volatility? Well, yeah, of course. Same logic behind a stock. You know, if you saw a stock go from 20 to 30 and you thought it was on its way to 40, wouldn't you be bullish? Okay. positive Vega trade. That's what we're looking at here. So it's actually a good candidate as well. Let's go back here. Trip, I'm going to circle it. Scratch the other two. Let's look at Walmart and Home Depot, then we'll run with one of these. Oh, Walmart, 16%. Even when it gets crazy, it doesn't go that far up. So 22 doesn't get me too excited. Let's look at Home Depot. It's probably going to be the same way. And, yeah, you know, is it technically at a low point? Yes, 21%. Okay, looks like it's curling up. It might be heading towards 26 or 27. It's just not a very big mover. You're not going to catch a big move in IV, and so that usually isn't going to be a great trade because you're fighting time decay while you're pricing in volatility. It's kind of a tough, tricky deal. I'd probably skip on both those. So let's look at XCC and Trip. Now, if you're going to build these, you go into a risk graph, into the Analyze tab. You plug in your symbol, and you follow your rules. Okay, you should have rules for your strategies. If this is a strategy you've never done before, get with a mentor, talk to them about how to build out rules. 2 to 4 months out, same strike. You got to have money management rules, and then also trade management rules as well. Let's go through an example here. So if we're looking at the days, 2 months out puts us out in June at minimum, or all the way out in September. I think for a Vega trade, when you're trying to trade earnings, you got to be within the cycle of that next earnings. So since the next earnings will be August, going out to September doesn't work for me. So what we'll do is we're looking at $83.52 stock. We're going to buy the $82.50, call and put because it's closest, and we're looking at an $11 straddle. Important to take note. Okay, I'm going to put in the implied volatility. We've got delta. Actually, get me a different layout. Delta, gamma, theta, vega. So we got theta, vega, gamma, delta. I'm going to take, we don't need the gamma rate in there. Make this one implied volatility. Okay. You'll notice this is very important. The vega is 14 per contract. The theta is only -4. So for every point in implied volatility we build on these options from 38% and 37% respectively, we're going to benefit 14 cents on the option contract. That's important. That's kind of what we're doing. We're losing $4 a day from time decay on the June. If you look at, say, the 4-day option, just to compare this, the theta is 11, the vega is 4. See how they're inverted almost? See, the shorter term options, theta is higher, vega is lower. The further you go out in time, theta is lower, vega is higher. You can even take this to an extreme. Now theta is only 1, vega is 43 on the 2-year options. See, there's a relationship there. Understanding that relationship will help you build the difference between your gamma scalps and your vega plays. See, whether you play them weekly or 2 weeks out, or whether you go out 2 to 4 months will depend on how you want to play Vega. Do you want Vega to be the main player? Do you want the Vega to drive the bus? Imagine you're on a road trip and it's you and it's theta, vega, gamma, and delta in the car. Sounds like an interesting road trip to me. Okay, sounds like an old frat joke somewhere in here, but I don't have it. All right, so you've got delta, theta, vega, and gamma in the car. Who's driving the bus? Who's driving the bus? Is it delta? Well, only if your trade is directional. The straddle's not. It's bidirectional. We don't care whether it goes up or down. We got in the car and said, hey, go north or south. I don't care, man. I just got to get out of here. Right? Is it time? No, we're not going to benefit from time passing. Okay? You know, we're going to lose from time passing. To go with the analogy, try to make the most out of this bit. I mean, we only got so much gas in the car. Time passing, we better get to our destination before we run out of gas because we got no more cash. We're only filled it up one time. Okay, is it going to happen real quick? Is it gamma? No, not necessarily. This is about implied volatility building. It takes weeks or a month for that to happen. It's vega. Okay, this trade, if we play it this way with Trip out in time, we're trying to take advantage of Vega. So we want to have a relationship between Vega and the rest of the Greeks to make Vega right in the driver's seat, hands on the wheel, taken us where we need to go. Now, what if we can't afford 1095? That's $1,000, by the way, almost $1,100. Well, don't trade Trip then. Find a cheaper stock. That's just money management. That's for your own personal account. You've got to build a list of candidates you like to work with. The idea here, though, is you find the strikes closest to the current stock price. You build it out as a straddle. I'm going to go ahead and send this one off. And actually, before I do that, let me look at the risk graph. Let me show you. Here's the risk graph, okay? Profit up here, profit down here. Doesn't matter if it goes up or down. The actual thing we're looking for is a volatility build. If we can get a 5% volatility build on the options, we can make money just from the volatility building. See how that white line just popped up just a little bit? Now the chart itself shows us that volatility on Trip can move from probably 45 to 55. Now that's the short-term volatility. Those aren't necessarily our options. We'd have to go back and back test it to know the math specifically. Thinking about the June options, let me look at the simulation again. 38%, they're about 8% below the current 2-month options that are being measured. I think you might be able to catch 7% just from experience. That would tell me there. Now, what does that do for me? It gives me a little cushion, okay? And if I plan on being in the trade, let's say I'm going to step this out, 4 different steps every 7 days. Pretty much for me to make any kind of real money, I need to do it. If it stays at the money, I got to do it in the next 2 weeks or the stock has to move. So my plan on this trade would be to play it as not a gamma scalp, but a Vega play. And I would probably, even though I'm 2 to 4 weeks out or 2 to 4 months out, the risk graph tells me I should only be in like 2 or 3 weeks. See, one of the mistakes I think traders make quite a bit with straddles, especially the Vega building, implied volatility building version of straddles, is they want to stay into them until earnings or until they make their money. You know, too often traders stare at the P&L column instead of trading the characteristics in the trade. Did volatility hit its head and now you don't have any more to go? Well, yeah, Tim, but I'm break even. So what? If the conditions in the trade are no longer there to make you need to be in the trade, you need to be out of the trade. Too many times people are still staring at whether or not they made $50 or lost $50, and they're not actually looking at the chart or the conditions as to whether they should stay in or out. This trade I would not hold all the way into earnings. In fact, what I would probably do is just wait for volatility to hit 55 or 56, maybe have a standing target out there, possibly even a stop loss, and try to make 10 or 15%. On $1,100, that's like $100. It's not $3,000. It's like $100, $200 at the very most is what I would be going for. Using the risk graph here, $100, $200 can happen with the volatility building. What if volatility doesn't build? This is an important question I ask myself every time. What has to happen for me to hit my $100? All the way till May if volatility doesn't build? Well, that stock's got to go to 90 pretty much. Or on the downside, it's got to be about 72. Okay, let's go look at the chart and see if we can catch it from the price itself. 72 is way down here, 90's here. 90 seems more likely, but it's a big move pre-earnings. I better not plan on the chart helping me out too much, okay, if I stay in longer than 2 weeks. It most likely is going to fade into earnings. I better catch the Vega build. My target would be about 10% is all. Maybe cover the commissions after that as well. Okay, it's a Vega trade. Vega straddle trades are not my favorite strategy. I only use them once every now and then. It's just a lot of time to tie your money up and fighting time decay. Some people like them. You know, even some mentors really, really like them and have shown a lot of success with them. You can be really consistent with them. You know, it's just not my personal favorite strategy. I'd rather have my money working in different ways. But if you're going to trade them, dial in your expectations, make sure you know what to look for, and build out your rules. And when I say your rules, I mean it that way. You know, it's got to be personal for you so you know how to execute it. All right, let's talk about, let me check my clock here for a minute. I've got this thing recording. We're at 40 minutes, so I was going to go about 50 here. Loading the video, open them for Q&A. That'd probably be all right. We'll see how long this goes. Maybe we'll go 60. All right, let's talk about outside of the straddle. We had one other, let's do another straddle actually. On instead of trip, let's look at XEC. Okay. Now XEC looks like it can go from 36 to 51 or so, probably in here. This is where it was the last few times. It hit into the low 50s. It's at a low. It should rise as it's anticipating earnings here in a few weeks. It's pretty volatile. Stock runs and sells, so you might get some price movement as well. So how do we build it? Well, we go into the risk graph, and I'm going to send that trip one off. So it's out there. Okay. Let's go into the risk graph, XCC. And let's simulate one. Looking at June or September, I'd probably choose June. $124 stock. It's going to put me at the 125 strikes. Here's my trade. $1,400 to trade this one. Can't afford it, not your money management, find a cheaper stock. The characteristics we're looking for are the same. You'd have to just scan differently. Remember, when I scanned, I looked for bigger stocks. And then we came over here, didn't really have a filter on price. You know, you're going to pay for a 2-month to 3-month option for the straddle. You're going to pay 10 or 12% of the stock price. Okay. So $100 stock, you're looking at $1,000, $1,200 probably. $50 stock, you might only be looking at $500 or $600. You know, maybe $7. $20 stock, $200, $300, $400. You know, so the stock price will have an impact on the underlying cost. There's no question about that. Now, looking at XEC here we are, rally, sell-off, rally, probably going to get some volatility building here. It could be a good candidate. Let's go back into that risk graph. Here's our trade. Risk profile it. We've got the day step in there to impact time decay. Let's see what kind of volatility we need this thing to go up. If it goes up 5%, oh, we're good for about 2 weeks. Okay. What if it goes up 10% like we were looking at? If we can catch a 10% volatility build on the specific strikes we're looking at, we would have a profit on the trade. Okay. Now the question we have to ask ourselves is the June contract going to rise 10% in volatility? Well, it is before the next expiration, next earnings, I should say, that would be in August. If we look at the actual volatility here, 33%, 33%. Yeah, probably. You know, we could go back and do some testing. We could use Think Back to go back and look at like the previous cycles of a 60, 70-day option, the 3 weeks before earnings, and see how the volatility changed. It's not enough, by the way, and this will drive some people nuts, to just look at this blue line. This blue line is an indicator of the first 2 expirations, 60 days and tighter. So the 67-day option is probably not even being measured here. And it's measuring those 2 expirations, but it's only measuring strikes with a nickel of extrinsic value or more. So not every strike is going to be built in there. If it has a 0 bid, it's not going to be built in there. It's an average. It's an average of all the strikes. It doesn't measure your strikes, and this is where people make that mistake. You can look at it to get an idea of the consistency of the general conditions in the options. Whether it will affect your options exactly these numbers or not, it probably won't. You have to think about which options you're trading. Because if you look at an option chain, every volatility number is different. Okay? They all have their own unique volatility measurement. The chart is just having the average of them all. All right, let's send the XCC off just for practice. Got 2 of those in for practice here. Just might as well practice them. We're building them, right? Might as well practice them. Now, the next strategy we're going to talk about with the remaining time we have is called a short strangle. Now, what a short strangle is, and it's a risky trade. It's kind of like an iron condor, but without any protection, okay? You know, when you do an iron condor, you sell a bull put. Well, short strangle has a naked put, and it has a naked call. Short strangles should only be used by traders with experience, understanding, a lot of trades under their belt, and with a, you know, at least an intermediate or an advanced understanding of options characteristics. But it is a very good strategy. If you're a new trader and you're not comfortable with short strangles, do them in virtual. You should do it in virtual first anyway. Or you can do the iron condor as a replacement. Okay? So if you don't want to do an iron or a short strangle, you can use the iron condor instead. If you don't know how to do either of them, well, just enjoy the video and see if you can learn something just from me talking about it. All right? So naked put and a naked call. Now the general rules I use for short strangles is I like to go, 2 to 4 months out, sell low delta options, and hold through earnings. Okay, now the characteristics I'm looking for are volatility consistently crushing, going back to our original graph. If volatility drops and crushes out, that's a good characteristic for us. That's what we're looking for here to play the short strangle. And let's see if we can find some. This is an easier scan, by the way, because then you just have to look for this week. So instead of this month, I'm going to say next 5 days. Over 1 million S&P 500 companies. I'm going to take that out and look for market caps in the mid-plus range, over 2 billion or more. Okay, instead of that price range, I'm going to say over 20. 36 companies. Now, we've got this built 17. Let's think. 13A is not going to work. 14B is not going to work. 14A could. Let's start right here. So let's pull out a few of these names. I'll just build some that I'm interested in. Delta Airlines, DAL. Schwabi, no. SanDisk, no. Steel Dynamics, STLD. Google, it's a big boy. Netflix, I would avoid because it's too random. Maybe let's see, let's set my price a little bit lower. Those big ones are going to have not great BPE effects. For a lot of people, that'll be limiting. All right, let's do 50 to 100 is a good range. Okay. Wells Fargo, JP Morgan, not going to have enough volatility. Schlumberger, SLB, and Seagate Technologies, STX. Let's start right there. Let's go look at this. Now, the first thing we're looking for is a consistent drop in implied volatility. DAL. Start there. Does Delta Airline consistently drop? Well, it dropped here. Dropped a little bit here. Had something weird going on right there after it was crashing with probably some of what was happening there. Yeah, I don't love it. Crushed a little bit here. It does consistently. This is kind of a concern, obviously, that big volatility spike. I usually tell beginners, if you see something weird, just go on to the next one. Steel Dynamics, okay. Built up to a high, crushed down. Built up to a high, faded down. Crushed off right here, faded here. So sometimes it fades, sometimes it crushes. We're looking for more consistent than that. Google. This is a good one. Okay, crush down right here. Crush down right here. See how it drops off a cliff there on that earnings? And I'm matching it up with these telephones right here. Okay, crushed off right here. Google's definitely a good candidate. Google's a $550 company. Now, this is one of those where you want to have the ability to do either the iron condor or the short strangle. If I look at Goog and I change these strikes from 4 to all, I would run the numbers on September and June and consider both of them, but let's take a 10 delta option here. Delta. 10 delta options, the 445 strike. If I sell the 445 September, and I also, and that's about 95 points down, and I do the 635 call option, this is a strangle. I'm selling the options. It cost $5,000 buying power to make the 800 bucks. Now, let me bring up a workbook real quick. Let's see. Let's go into documents. I gave you guys access to this credit research workbook last week. So if you don't have that, make sure that you do get a copy of it. See if I can bring it up. Okay. Now I need to run the numbers, and I need my calculator. Now I usually do these in what's called the Iron Condor tab here, but what I do, and I usually do a little bit of rounding on the prices, not that important to me actually. Okay, it's about a 540 stock, so that's fine. So I'm going to put in 540 here. If I do September, and the short call strike was, let's go look at that. The call strike was 635, put strike 445. The delta on those strikes was 12 and 10. Okay, 635, 12, 445. I've got to go confirm that now. There we go. Now, if I'm looking at this, okay, let's make sure I'm 445, 635, 445, 635. Now, the net credit on this, and these are all just numbers I'm picking up from this thing, the net credit is 823. The buying power is not going to come in automatically here. You actually have to manually do that. I'm finding that right here, 5,400 bucks. This will give me my ROI and my ROID numbers. Now, if I want to reduce the risk or the cost, it's simple enough. I can just do a Condor instead. This is where with really big stocks like Google, it may be better to use an Iron Condor. I'm going to do a 10-point window here. So 445, 435, 635, 645. Okay, 172 cost and 828 right there. Buying power. So let's delete this out. So this is, actually we'll just double this up. So if it's 540 stock and we use September, but we do the 635, still has the same delta, but now we're buying a contract. 445 still has the same delta, but now we're selling we're buying another contract to hedge the risk. Net credit's 172. Buying power on that 10-point window. Now this should be 8, and let's see if we can get the exact math. 828. Okay, ROID is 188%. You see how actually using the spread, I improve my numbers? But there is a trade-off, okay? And the trade-off is you don't get the pure play on Vega. See, when you're looking at a risk graph, the difference between Condor and Strangle, if I do a Strangle, my Vega rate is negative 133. I'm going to benefit fully from the drop in implied volatility. If I do an Iron Condor, my Vega rate's negative 18. Now, one would argue, well, yeah, but you spent a lot less money. Touché, salesman. Absolutely. But it's not transferring perfectly, okay? You know, you're not getting the same impact from volatility dropping, but could be a candidate. This is Google. We'll do this one as an Iron Condor. I think the cost would limit a lot of people out, price a lot of people out. You don't really want to drop 5,400, probably unless you're working with a couple $100,000 or more in a trading account. is what I would guess would be the size of your account would need to be. Let's go for a little smaller one, see if we can find one in a different range. All right, Wells Fargo. That's a $55 company. Okay, Volatility Crush, Volatility Crush, Volatility Crush. Doesn't gap a lot. Let's look at this one as a candidate. All right, so if we go to the risk graph, plug in Wells Fargo, simulate my trade. Again, 2 to 4 months out. July's perfect. 95 days is perfect for this. Low delta. Now, for this one, I'm going to do, since it's a 54.50 stock, the MMM projection's about 2%. I think 49 strike is plenty. I'm going to sell that one at 17 delta. That's 5.5 points down. So from here, it's going to be the 60 strike. Really skewed volatility here. Wow. 5.5 points down, you get 60 cents for the put. But 5.5 points up, you only get 20 cents for the call. Interesting. They don't believe it's going to gap up or be very bullish. So we would have a tough call here. We either can sell the 10 or we can sell the 24. Or we can scrap the 49, sell this 45 and get tons of room. Why don't we do that? Just be safer. Do the 60. So here would be an example. It's a $558 cost. There's only 39-cent credit. That'd be a tough sell. Okay, tough sell for me, not getting enough credit to justify that 558. We would plug all the numbers in here, make sure we understand them. The point of tonight's class is to introduce the thoughts to you, to get you thinking about it so you can start practicing. Okay. Short strangles. Let's see if we can find another one. One more maybe. Let's look at SLB and STX. SLB we looked at earlier. Let's look at STX. Seagate Technology, gaps from 65 to 58, it's a 7-point gap. Pretty good volatility after this. We don't love these. We want to see consistency here. You are getting the crush, the crush, the crush, the crush. If you got a big enough window, you could make it work. I think with this risk, I would need about a 15-point window up and down. So from 55, I'd probably need to be all the way up at like 70 and all the way down at like 40. I doubt there's money there. Let's go look at it. STX. Okay, 40 is an 8 delta. That might work. Okay, September options are ways out. That's fine. Okay, and then 70 is a 9 delta. That might work. So now we're an 86-cent credit on 554 cost. Let's plug these numbers in, just kind of talk about them. I like using spreadsheets. They just keep my thoughts organized as I go through. As you can see, you go through a lot of numbers. It's easy to kind of get lost on stuff. These are September. Short strike would be the 70. The delta, I think we said it was an 8. Yep. Okay, 0.08. No long strike. Short puts the 40, 0.09. No long put strike. Okay, the credit, 86, BPE 554. So 0.86, 554. Throw me up a number. Good ROI for that low delta. It's not a bad candidate if you're comfortable with the gap risk. Yeah. There's a lot to these. My rule is you got to practice 50 before you put one on live. Okay, so if you're interested in trading earnings or the short strangle, you better get to work because you got to put about 50 of them on before you ever think about doing one live. And that's from entry to conclusion and making sure you know what you're doing, making sure you understand how the gapping works, how to size them, how to position size them, all that kind of stuff. It's a good strategy. It's a really good strategy. It requires that you're willing to manage and understand the risk on these downsides, though. This is not a beginner's trade. It's an intermediate or an advanced trader's trade. Okay, you have to identify where you're at in your own education. Are you comfortable with that? Can you take advantage of it? Can you handle it? When I'm about to lose my voice, I know it's about time to go. Implied volatility, it's the cycle. It fades up, 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 and then we crush down. So which part of that do you want to take advantage of? That's really what we've been talking about here today, is learning how to trade earnings. Now, there is one last possibility. Maybe you can just avoid earnings. Some of you might be thinking, well, I don't want to trade earnings, Tim. Okay, trade your stocks, trade your Forex, trade your credit spreads. Just make sure you look it up. Make sure you look the information up. If you don't want to play the gaps, if you don't want to play the earnings, if you don't want to play the volatility, you can find a business outside of that. I like them. I think they're very, very neat strategies, and they've got a lot of history behind them. Just the volatility crushing is one of the most consistent characteristics in markets. But if your personality is such that you don't like taking risks around, that random event because you don't want to play it, well, don't play it then. Just look it up at minimum. You got to be organized enough to know where you're at. Okay, thanks for attending here today. If you have any questions, feel free to buzz me an email, or we'll see you back here on Monday. Take care. See you guys.